to be having this session today. I think it's very timely with kind of the current economic conditions, also the rate hike being announced today for those who haven't seen the news. Um, I think this demonstrates two things. First, the great partnership that exists between Coconut and Vancity. Um, I kind of threw a hope and a prayer out, and on my normal points of contact, Rich and Chris were very eager to get me connected with Amanda and her team. And then secondly, it gives me an opportunity to also meet more people at Vancity, which is always great. For those that I haven't met, for too long or yet on the Vancity side, just wanted to give you a quick intro to Coconut. Um, on the call today, we're going to have people from coast to coast. I think we're around almost 140 employees now, and it looks like about half of them are able to attend today. So definitely there's a regional aspect to it. There's also a different mix of roles and ages in the group. We're going to have, programmers on our side, customer service and customer success individuals, product leaders, and then all the way up to the executive and staff as well. So I think there's a good mix in terms of where people are in their lives and their different financial goals. So I think this is going to be very helpful to them and to us in the long run, as well as kind of helping kind of navigate the current kind of short-term situation we're in. So really appreciate it again, and going to hand the mic off to Vancity.
Excellent. Thanks, Jonathan. Good morning, everybody, and Happy New Year. I'd like to start out by thanking the Coconut organization for providing us the opportunity to speak with you today, and to thank you for taking the time to join us. Before I get going, I'd like to acknowledge that I'm coming to you from Surrey, British Columbia, where we're gathering on the territories represented today by the Musqueam, Tsawwassen, Squamish, Tsleil-Waututh, Kwantlen, Kakite, and Semiahmoo First Nations. They've been custodians of this land for thousands of years, and I would like to pay my respect to the elders, both past and present. My name is Amanda Greenlees, and I am the team lead for wealth planners at Vancity in the Surrey, Delta, and Langley area of BC. And before accepting this opportunity to lead a remarkable team of wealth planners, I had myself practiced as a financial planner for many years and continue to hold the Certified Financial Planner designation. I believe that the greatest gift that your advisor can give you is confidence in your situation and hope for your future. I hope that each of you will be able to take something away from this presentation that improves your peace of mind regarding finances. Vancity is a credit union located primarily in BC, and we pride ourselves in being a financial force for change. For the last 75 years, we have been active in our local communities and have been pioneers in many ways. We provide access to financial services and advice regardless of your balance. In 1980, we were the first among our competitors to provide term deposits with a balance of $100. We remain focused on the well-being of the earth and our community and launched the first socially responsible investment lineup in 1986. In 1989, we introduced the Vancity Community Foundation and became the first charitable foundation associated with a financial institution. And one of my favorite firsts is being the first credit union to issue a mortgage to a woman without a male co-signer. We stand for diversity and progress in everything that we do. As you navigate your financial journey, it is important that you work with a professional from your province. It is their job to guide you through options that are specific to your area, like taxes and government programs that can be of benefit to you. Today, we will cover a wide range of topics, including managing cash flow, planning for retirement, asset management, and taxes. And we are fortunate to be joined by our speakers, Balazs Chima and Alisa Belovnev. Balazs has been with Vancity since 2017 and has served Vancity members in various roles. He has been serving Vancity members as a wealth planner since 2019. Balazs has a Bachelor of Business Administration with a major in finance and is pursuing his CFP designation currently. In his spare time, Balazs enjoys working out, traveling, and playing golf. He is also a strong promoter of our socially responsible investing mandate. He finds great pleasure in helping his members achieve their financial goals. Alisa started her financial career in 2018, helping clients with their day-to-day banking, mortgages, and investing. Since then, Alisa has found her passion in specializing in financial advice and investment planning with Vancity, where she is able to help people invest sustainably and build healthy financial habits. Without further ado, I will turn this over to Elisa, and she will take us away on our journey today. Thank you.
Hi, everyone. I just want to start by saying thank you again for joining the webinar, whether it's your morning or your lunchtime, the fact that you're taking time away from your day just to listen to what we have to say. Hopefully it's valuable, and we hope that it's helpful. So today I'll be walking us through first the basics of managing cash flow and general planning for retirement, and then I'll pass it along to Balazs to take on the second half. So my section is going to be based around creating a general plan for yourself. A plan is how you're going to get from point A to point B. It's your recipe for success. And so that's what we wanted to kind of start today on to lay the foundation. Financial planning can be very complicated or very simple, depending on how you look at it. I like to view finances as sustainability. We talk about sustainability a lot when it comes to our businesses and our footprint and our impact, but less so when it comes to our own finances. So when we talk about financial planning, we want to use whatever resources that you have available so that you can have the lifestyle that you want today, but also be able to sustain that into the future as you go through your different life stages, whether that's building a family, buying a home, getting married, retiring, whatever it is. And when it comes to financial planning, oftentimes we think that it's the simplicity of knowing money in, money out, but there are so many different areas that we do want to be mindful of because there is the idea of planning for the unexpected. So cash management and retirement planning and investment planning, that's all kind of the basics. And then we also want to think about how are we planning for taxes so that we're not paying either a large tax bill or even getting a large refund because we want that money in our pocket sooner. We want to be thinking about how we're managing our risk. Of course, there's always going to be a balance between risk and return. So you want to make sure that you're taking on something that's going to be comfortable for you, but also helps you meet those goals that you want. And estate planning, incredibly important. I think that whoever has gone through the process of helping manage someone else's estate, that's the biggest learning experience I find that people go through because they realize that it can be complex if there hasn't been a proper plan in place. So estate planning is making sure that when you pass, you're able to pass along your savings and all of your hard work along to your loved ones and do it in as simple of a way as possible. And special needs, of course. So everyone's situation is going to be different. So these are the basics, but there could be some other areas that you want to think about as well. So once you know what areas of financial planning you kind of want to start working towards, there's a process that you can go through to help guide yourself through that. So I recently had an email a couple of weeks back. We'll call her Sally. And this is a true story. I'm not just making it up for the presentation. So Sally sent me an email. She talked to a couple of financial advisors before. And she essentially said, hey, I found your name from the Vancity website. And I wanted to talk to someone because I feel like I'm missing my holistic advice. She has investments. She's moved her money around, but she doesn't feel like she really has a strong understanding of what's going on and what she's doing. So we had a phone conversation, and within a couple of minutes, I got a strong sense that she knew about her finances. She had a very strong foundation, but I had a hunch of what the missing piece was. So I asked her, like, what are your actual goals? What are you saving for? What do you want to do? And she didn't know. So our conversation then pivoted just to understanding what it is that she wanted to save for. Did she want to make sure that she could travel once a year? Was she hoping to retire by a certain age? What kind of aspirations does she have in life? Big purchases. So you want to take some time to sit down either with yourself, with your loved ones, whoever is involved with your finances, and have a conversation about what your goals actually are and agree upon which ones are most important and what do you want to work towards. It's a really simple first step, but often overlooked because we like to get into more of the complicated parts of financial planning. So once you know what you're actually saving for, you can gather up your data. So with Sally, we took a look at her cash flow, um, what her income was, what she expected it to be, what her expenses were, etc., and then analyzed it. So we took a look at what parts of her spending were necessary, what parts brought her a lot of joy in life, and what parts might be a little bit more discretionary. And, if she had to make do without, what could she do without? From there, we started talking about what she could actually do in order to start reaching her goals, which for her was find some kind of stable housing within the renting market and also work towards retirement at around age 65. So for her, that meant she had to save around a couple $100s per month, had to be invested in something that she'd be comfortable with. And it did also mean being really structured in her savings plan and her spending habits. And from there, I'm going to be talking to her next week. We'll set up a savings plan for her, get her a short term savings account where she can spend for her day to day and her vacations that she wants to go on, and also something to save for her long term future and her retirement. And one of the values of working with an advisor is then you can then monitor this plan with them and meet with them on a regular basis and just make sure that you're still on track and make changes as needed because it's always going to be a work in progress. And talking about goals, it's very important to know what your goals are. There's a lot of cliche goals of buy a home, save for kids' education, save for retirement, but things are going to be different for everyone. Some people want to save incredibly aggressively and retire as early as possible. Other people, like my partner, he loves what he does. He doesn't care about retiring as early as possible. He just wants to have cash flow to fund his things that he's passionate about. So make sure that you're concentrating on what's going to be the most important to you because that's what's going to be motivating for you as well to then take action. And again, speaking of goals, one of the most helpful steps you can do is divvy them up into sections of short, medium, and long term. And the reason being is because this will help you prioritize them, but also select which investments are best suited for those goals, which is something that Balaj will help cover. So, short term goals, oftentimes it'll be setting up an emergency fund, which I'll touch on, travel, home renos. Medium term tends to be saving for kids' education, buying a home, a new car, any other kind of larger purchases. And those long-term needs are going to be likely saving for retirement or planning for what kind of legacy you want to leave behind as well. So a helpful step is knowing what your net worth and your cash flow are, because this is going to give you a starting point. So a net worth statement is going to be gathering everything that you own, everything in your savings accounts, your pension plans, your group RSPs, any kind of assets that you own as well, your car and your home. Tally all of those up, subtract any debt that you have, and that's your net worth. So if in theory you were to sell everything that you possibly had, how much money would you have to your name? And this is also going to be a helpful gauge for how you're progressing. So you can take a net worth snapshot at the beginning of the year. This is what I like to do. I'll write down all of my assets, my debt, and my savings on January 1st. And every year I'll do the same thing and I'll get to see how I'm progressing. Cash flow is going to probably be determining how that net worth changes. And so this is quite simple. It's whatever you earn minus what you spend. That's your cash flow. It's helpful to know what all of your fixed expenses are so that you know how much you have flexibility to spend beyond that. But more than that, I think the greatest indicator of cash flow is looking into the past and see how much you've been able to save historically. Oftentimes, we tally up our expenses, we find that they're not entirely accurate. A lot of my clients find that they theoretically should have a surplus in savings that they don't necessarily have. So I think that the most accurate depiction of what your cash flow is simply looking at um, what it has been in the past, what you've been able to save. And Paying yourself first should be a part of your cash flow. If you take anything away from this webinar, I would love for it to be that you should pay yourself first before you take your paycheck and you spend it on the things that you enjoy doing, like eating out or social events or things like that. The first person that you should be paying is yourself. So the easiest way I find to do this is set up some kind of recurring savings plan. Paycheck comes in, and you take out a certain amount of money, a set amount, and put it aside into a savings account and make it automatic. That way it's structured into your finances, into your cash flow. You don't have to think about it. And it builds a really strong habit of always thinking about your financial sustainability and making sure that you're taking care of yourself for the future as well. And just a few slides left for myself. I wanted to touch on starting with the basics. For some, this may already be complete. For others, perhaps not. And so I wanted to quickly touch on it, saving money, emergency funds, and then talking about debt. So an emergency fund is going to be what takes care of you if something happens. So if something happens to your income, you're no longer receiving that regular deposit from your employer into your bank account. How do you keep a roof over your head, food in your tummy, the heat on in your home, paying your bills, covering your debt obligations, and all of that? You want to make sure that you can cover your essential living expenses during that time for around 3 to 6 months. So that's going to be what can cover you in case of that kind of emergency. And this is going to be the very first thing that you want to take care of if you're starting to really think about making a financial plan for yourself, because you want to make sure that you have this strong foundation to fall back on. For where you should be keeping this emergency fund, it should be easily accessible and stable in value. So that will likely be a savings account, a cashable term deposit, or perhaps even a line of credit. The last tip that I have for this is don't consider your retirement savings as part of your emergency fund. That should be set aside for the long-term future. And there's many reasons for this, for why it's best not to tap into that. So if you do want to use a certain account for your savings, it should either be just a regular, checking savings account or a tax-free savings account, which again, Balazs will touch on. And lastly, talking about debt. This is unfortunately something that's on many people's minds right now as we're going through these interest rate hikes. As a rule of thumb, it's best to pay down that highest interest rate debt first. So if you have a credit card debt and also maybe a loan from your bank, likely you're paying a lot more in interest on that credit card versus the line of credit. So the longer you carry it, the more it's going to cost you. So for those higher interest rate debts, it's best to pay them down as fast as possible. And even better is to consolidate them. So sometimes I'll come across folks who have been through some challenging times and they have different sources of debt at different interest rates, and it's a bit difficult for them to manage it and keep track of all of it. So one option that people have is to consolidate. So you talk with someone at your primary financial institution, give them the full picture of all of the sources of your debt, what the interest rates are, and they can hopefully qualify you for a singular loan that can then pay off all of those different sources of debt. And so it would all be in one place. And the idea is that it would also be at a lower interest rate. So it's going to cost you less along the journey of paying that off. It also helps because that way you're going to have a singular monthly payment and it's going to be a really structured plan in order to slowly reduce that debt. And sometimes it can be better to pay off not the highest interest rate debt first, but the highest monthly payment debt, because it can free up some of your cash flow to take care of the rest of your obligations. But that comes with a bit of an asterisk. Usually we do recommend paying down the higher interest rates debts as your first step. And with that, I will pass it along to my friend Balazs, and he'll go a bit more into detail when it comes down to what accounts you have the options to use and what investments you can select for them.
Thank you, Elisa. And I just wanted to take a minute and just mention that we are going to have a Q&A session right at the end, and we'll try to spare maybe 10-15 minutes for that. So if you guys want to just you have any questions come up during the presentation, please feel free to pop it into the Q&A section, and we'll be more than happy to go over those questions towards the end. Once again, I'll start my presentation off. Obviously, the road to financial independence is paved with good investments. So Lisa's talked a little bit about obviously your cash flow, budgeting, emergency funds, but we'll move on to a little bit more about once you've established your goals and a strong financial foundation, you're obviously ready to begin investing for the longer term. So we'll look at a few ways that you can invest your assets. These are obviously some of the more popular plans that we'll be going over today. The first one being the RSP. Now, the RSP stands for Registered Retirement Savings Plan. It's something where you can contribute to it and you can create an income for yourself in your retirement years. We'll dive a bit deeper into the RSP later on, but I'll just mention the other accounts as well. So next, you've got another popular account, which is termed popularly as a TFSA. Stands for Tax-Free Savings Account. It's a flexible and general purpose account that allows Canadians to earn tax-free investment income on their savings. And we'll touch base a little bit more on the TFSA as well in detail in the next few slides. Lastly, obviously, there's another great account that's termed as the RESP. You may have heard about it before as well. For those of you that have kids, it's a plan that stands for Registered Education Savings Plan. Like the plan suggests, it's a savings plan meant to be utilized to save for post-secondary education, usually for children or your grandchildren. And then yes, so some of the growth is tax sheltered, and the government grants are tax sheltered while the money stays in there. But we'll move on to the next slide and talk a little bit about like a bit more about the plan types. So with all these plans, whether it's an RSP, TFSA, or RESP, you want to think of them as toolboxes, because a lot of times people just think we need to put money into an RSP or a TFSA or an RESP, and then it kind of just sometimes sits there for years. It might have happened to you. We see it happening with members all the time. But the reason why we refer to these plans as toolboxes is because you want to, inside the toolbox are different tools that you can use. And essentially these tools, when we refer to these tools, they're just essentially savings vehicles that you can use to sort of save or invest within these programs. So some of the options listed there, and like my colleague Elisa went over, like your short-term, medium-term, and long-term goals. There's different products that can be used for to service different type of obviously planning needs. At the very basic level, you have your cash or cash equivalents, which is a basic savings account or money market funds. With these type of investments, you generally see obviously lower returns and lower risk involved with them. So they're generally good to be used for those shorter term savings needs, where like if it's your emergency fund or you're saving for a vacation or saving for a trip or a vehicle. Sometimes these kind of tools are really useful in that sense. Then you've got obviously income-based products. These include term deposits. Some banks will call them GICs. You have bonds. These are all interest-paying products generally that usually come with a certain set time frame, and you get a set interest rate paid out depending on the product terms and conditions. And lastly, obviously, you have growth-oriented products or stuff that you invest into for the longer term. So this is where that longer term planning usually comes into the picture. And this may involve equity-based investments like stocks and mutual funds. But we'll dive a bit deeper into RSPs on the next slide. So obviously a common question, why an RSP? So first off, your contributions are tax deductible within a limit. So for example, if an individual earns 50K and they make a 5K RSP contribution, this brings their taxable income down to $45,000, which leads to less taxes paid within the year of contribution. The purpose is to contribute more in your higher earning years and withdraw when you're not working or are earning less, essentially. So income earned in your RSP is tax deferred, potentially for a very long time. Hence, you keep more of your investment income and give the government less when you're contributing in. And then also, like I mentioned earlier, when you withdraw, your tax rate may be lower as well, depending on future income and taxes when you withdraw as well. But we'll dive a bit deeper into the RSP on the next slide as well. Who is eligible to open an RSP? So individuals, not trusts or corporations, can open up an RSP. And we've listed a few of the criteria on the slide there. Like you have to have a valid SIN number, and you have to have reported earned income on a Canadian tax return, which then leads to you earning RSP contribution room. This can be found obviously logging onto your MyCRA account, or also by calling the CRA up as well. But essentially, these are the two general parameters. But the main parameter, how you earn RSP room, is by reporting earned income, whether that's from a job or self-employment as well. So obviously, we've touched base a little bit on like the plan types, and we've gone a little bit more into detail of the types of plans. We'll just stop a little bit there. Just like Elisa, my colleague, mentioned how you want to calculate your net worth. You also, the way a retirement plan kind of starts off is by sort of assessing what you'll need in retirement, and how you can kind of go about that is first trying to calculate what kind of income you'll have in retirement. Now, this will have features like some of the government plans included, like CPP, which stands for Canada Pension Plan, and OAS, which is Old Age Security. Those are some government introduced programs that some people qualify for, depending on different parameters. And then also, if you have a company pension or a company group RSP, and then also your personal savings as well. So if you've been contributing to your RSPs or tax-free savings accounts, that's also factored in. So you take all of that income that you can foreshadow or you can foresee in the future, and then you want to, on the other side, you want to count up your expenses. So obviously in retirement, the biggest thing that we look for is, obviously there are rules of thumbs of using 70% or 60% of your income today. That's one way of kind of gauging your expenses. The other way is obviously for as you're getting closer to retirement, to foresee those expenses as well. So you could factor in the fact that in retirement, maybe you don't have as high of a mortgage, or your home is paid off. Maybe your travel costs go down. So some of the expenses that you have today may be lower in the future, or they may be higher as well if you obviously are planning on traveling or spending more time on a hobby. But each plan obviously is catered to each individual. That's the biggest takeaway that I'd say you want to take from this meeting as well, is that you obviously, not one solution fits for all. So on the expenses side, you will kind of want to gauge that when you're working on a retirement plan with the professional. And then so you want to take your retirement income and your retirement savings and subtract that from the expenses you have. And now we'll look to the next slide. So we touched a little bit on the retirement income part and RSPs. Just a little point on tax-free savings accounts as well. So why a TFSA? A lot of people confuse this as a savings account just because of the name. As it suggests, it's a tax-free savings account. And I've encountered this many times during my time out here at Vancity as well, where people will open up a TFSA, and at the very basic level, it may just be like operate like a basic savings account. But that's once again where you want to treat this as a toolbox, and then within there you'll have your different toolkits. So you can invest your TFSA into a savings account. You can invest your TFSA into a term deposit. You can invest your TFSA into stocks and mutual funds as well. So you definitely want to be utilizing the toolbox with the tools inside, not just carry the toolbox itself. But just a bit about the TFSA itself. It was a program introduced back in 2009 by the federal government in response to obviously the big financial crisis that we had in 2008. It was kind of introduced to help households build up savings for themselves and offer an alternative plan as opposed to the RRSP. So it is a way for individuals who are 18 or 19 years of age or older and who have a valid social insurance number to grow their money tax-free throughout their lifetime. The one big difference between a TFSA and an RSP is that contributions to a TFSA are not deductible for income tax purposes. So like your RSP, where your income is directly impacted by a contribution, with a TFSA you're putting in after-tax money into a tax-free savings. So any amount, but the benefit to this is that any amount contributed, as well as any income earned in the account, for example, which it could be investment income, interest income, or capital gains, is generally tax-free even when it is withdrawn. So over time, with the power of compounding, this can be a very, very powerful tool as well. So we'll look at obviously the next slide. This is a great quote, and we kind of use this regularly in our meetings as well. The best time to start saving for retirement is 25 years ago. So time's like a very important part in any financial plan. The earlier you can start, the better it is. And obviously the second best time is today. So for example, assuming retirement age of 65 and a 5% annual return, someone who makes about $100 monthly contribution starting at age 25 would end up with $150,000 compared to the same contribution starting at age 50, which will only lead to $27,000. So it's just to illustrate the time essence in investing. So somebody who starts 25 years versus somebody who starts at age 50, you can kind of gauge how big of a difference it is as well. And we'll look into the power of compounding a bit more in the next slides as well. So this is a great graphic because it kind of shows the power of compounding once again as well. It shows how slowly your returns start to outweigh the initial investment that you're making as well. So as you can see, initially, obviously within this graphic, sort of your investments and the return from your investments are slowly, obviously at a much lower point. But as over time, as the value of your investments obviously goes up in a cumulative manner, so do the returns as well. And after a certain period of time, your returns from compounding far outweigh your investment into the plan itself as well, because the investment is highlighted in the blue over there, and your returns from compounding are in the orange. So definitely, obviously, this further exemplifies the importance of time and obviously taking time. And that goes back to Lisa's point of paying yourself first as well. But now we'll look a little bit about what are equity and stock market investments, because I know obviously we have a lot of industry jargon within the financial sector, and not everybody may be aware of it. So you just want to take a moment to explain what are equity and stock market investments. So a stock at the very basic level represents a share in the ownership of a company, including a claim on the company's earning and assets. So when you're purchasing a stock, you're actually purchasing a part ownership within a company. And the purpose of that is, as the value of a business rises or drops, obviously, the value of the share changes as well. So individuals will invest into these companies in the form of these stocks, and they'll invest in companies that they believe will have chances to be more valuable in the future. So, for example, just taking an example of Tesla, like if you were kind of hearing it in the news, or if you were following a bit of the movement towards electric vehicles, you may have seen that Tesla was a newer company at the time, and they were obviously trying to disrupt the car market. So, as an example of why what stock investments are, why they're important, if you had kind of foreseen that this company has a great future, or they're obviously offering a product that will change a particular industry, you would buy their stock to kind of obviously ride along that wave of rise in value. So that just kind of is an example to show you obviously what are stock investments and why they're important. So this is a great slide as well, because this sort of goes into a bit about risk tolerance. So risk tolerance essentially refers to the ability to withstand a downturn. It's obviously a high time to talk about this right now, with all the market volatility that we've seen last year, all the news that we've seen about the economy and interest rates and inflation, all these topics. But essentially, risk tolerance, it just refers to your ability to withstand a downturn. Obviously, high reward requires high risk tolerance. So you'll see on this graphic, as the risk rises, generally the reward rises as well. And then you have products in the middle as well that obviously kind of look to balance these factors as well. You have your savings accounts starting off right at the beginning, and then you have equity-based investments like stocks that I previously mentioned, and specialty products and real estate right at the top with higher risk and obviously higher reward. One thing to kind of use to gauge your risk tolerance is something we refer to as the sleep ability factor, which essentially means that it's a test you could do for yourself. Will your investments keep you up at night? Or do you have sleep beauty, on the other hand, which is the approach to investing where you could fall asleep and wake up 25 years later and find everything just fine and obviously a lot more positive. So that's just one way to kind of gauge your risk tolerance, and advisors will kind of use those terms all the time. But this slide kind of shows you the different levels of risk versus reward. So this is very timely as well. What to do in challenging times. So obviously, there's two ways to kind of approach this. The first way is to obviously prepare in advance. So well, to obviously face challenging times, you want to be prepared as opposed to reacting after the fact. And obviously preparation includes, hopefully you have had created a financial plan for yourself of some nature before. If not, obviously now is just as great of a time to do that as well. But what you can do in challenging times is hopefully you have created a financial plan from the past. You have an emergency fund, all points that Elisa has touched before in this presentation. And then you hopefully have a good relationship with an advisor you trust. But obviously at times when hard times do come, what can you do at those times? Stay focused on your longer term investment strategy and your goals, I would want to mention at this time. So what this means is hopefully the financial plan that you created for yourself, you kind of factored in all these factors that a downturn can come when you're looking to kind of access those funds. So you want to stay focused on your long-term investment strategy and goals. You want to maintain a diversified portfolio. You don't want to put all your eggs in one basket. You definitely obviously want to have your shorter term savings separated and an emergency fund separated for yourself. And then obviously for your longer term goals, you want to keep that money aside with the goal that you're not going to be touching it for a longer period of time. Investing on a regular basis, we'll kind of touch base on this then on the next few slides as well. That's a great way to kind of navigate when hard times come or uncertain times come. And then also the key is watching for buying moments. So when everybody's selling, that's when you should be thinking about buying. It can be easier said than done. It's very easy for me to say that, but you have to be strong and you have to seek professional guidance at the same time as well. But obviously, times of distress are also great buying opportunities as well. And with all this, obviously, you want to talk to a trusted financial advisor. And why we include the part trusted as well is obviously somebody like Elisa's mentioned that will look at your holistic picture, not just focus on one singular investment or the topic that you have in mind today when you're coming to them. Next, we'll look at, so like we kind of touched base on this a little bit before on the past slide. This slide just sort of goes to show you the dollar cost averaging strategy. So like I mentioned earlier, investing regularly can be one good way of navigating uncertain times. So when you're in times like this, when a lot of people have questions about interest rates, when will they stop rising? When will the markets be more confident in the sentiment? When will the economy recover? Like these are a lot of questions that people do have at this time. A lot of this can be avoided by trying not to guess things and not trying to time the market. You could kind of take out that fear factor from the investment process by dollar cost averaging. So this graphic sort of goes to show you how a lump sum investment would do versus a monthly investment of $1,000. So in this time period from January to August, obviously this is for illustration purposes only. When you made that lump sum investment, maybe at the start in January, towards the end of August, because the market kind of did its ups and downs, you sort of ended up with a 0% return. But on the flip side, when you were making those $1,000 monthly regular contributions, because you got some of those buying opportunities when the market was at a lower point, yes, you made some purchases at a higher point as well, but your overall average return ended up being 4% because you had some of those lower average buys in there as well. So there's just two things. It automates your savings, obviously, so dollar cost averaging is great there, and it also helps take away that factor of, is this a great time to be investing? Once again, like the dollar cost averaging strategy, that's one strategy to follow as well during periods of hardship. But there's also the buy and hold strategy as well. So this is obviously a graphic that shows the S&P and TSX Composite Index. So this is a popular index that follows some of the top companies in the US markets and the Canadian markets. It's going back obviously almost 50, 60, 70 years, and it's going to show you that over time, obviously the market has had downturns and it's had its periods of upticks as well. But generally speaking, obviously, if you have certain goal, you have a certain time frame attached to it. Let's say it's retirement and it's 30 years down the road or 20 years down the road. You kind of want to obviously use the buy and hold strategy. There will be periods of downturn. Generally, obviously, as we can see from this graph as well, if you sell in a period of downturn, the market will generally recover over time and be at a much higher point. But once again, if you're trying to buy in and sell out in between these conjunctures, you may end up working against yourself as well. So obviously we're getting close to the end of our presentation over here. So Vancity has a full range of wealth professionals and financial solutions available to help you. Our advisors are able to support you in BC, Alberta, and Ontario. I know it was mentioned in the call earlier that there are some Coconut staff that are in other provinces. We'd recommend to obviously seek advice from a local credit union there as well. But those of you that live in BC, Alberta, and Ontario, if you'll feel free to reach out to us, our contact details are listed there as well, with the phone number and email, and then also a link to our website as well. We'll just touch a little bit briefly on socially responsible investing as well. So this is a big topic. Sustainability is a big topic in today's world, and you can make a difference with your investments as well. And you may have heard this obviously from a friend or maybe an advertisement, but not many people know what exactly goes on within social responsible investing. So I'll just touch base on a little bit of a process of how Vancity kind of offers certain products that are socially responsible. So we kind of follow a negative screening and positive screening process. As you can see on the screen, just as an overview of this, we will look to obviously negatively screen some companies, and what we'll screen out are certain industries like fossil fuels, tobacco, nuclear power, entertainment, military, and gambling. And then we'll not just stop there, obviously, as well. We'll obviously look to positively screen like our companies that we are actively investing in as well, to seek them and ask them for a higher commitment to ESG standards and criteria. And that may be on a lot of those lists listed there. So it's not just negatively screening out stuff that we don't want to be investing in, but also we recognize and understand that no company is perfect. So the companies we are investing in, we'll try to actively engage them as well, with regular dialogue as well. So with that, we are coming close to the end of our presentation. We appreciate your patience and appreciate the turnout as well. And we'd love to answer your questions. And I will pass it on to my colleague Amanda, and she'll let us know if there's been any questions, and we can go from there.
Excellent. Thanks, Balazs. We don't have any questions coming into the Q&A section. So I just want to direct your attention to the top of the screen. So you see the chat icon, and towards the right, you'll see a Q&A icon. If you click on that icon, it will allow you to type your questions in. But we do have a few that we pre-gathered, so maybe we'll start with those ones, and then we can go from there. Just bear with me 1 second. So Balazs and Elisa, maybe one of you can take the question, how do I know if I should do an RSP contribution or not?
I'll start off there, and I'll let Elisa chime in if there's anything that I miss. But yeah, with RSP contributions, it's a great topic. It's a very common question, especially in the time period we're in right now, which is the first part of the first 60 days of any year. It obviously depends on several factors, and we've touched on those factors a little bit in our presentation as well. It all depends on obviously what your income looks like today, what your retirement goals are, how your income will look like in retirement. Those are just some of the factors to kind of take into consideration. But I'd always twist the or put the question back to you, where you want to be working with your situation and a trusted advisor that you can work with to kind of help you navigate through that, whether obviously it's an accountant that you work with or it's a financial advisor that you work with, but you want to have an open dialogue about it and then come to that conclusion. And it may vary from year to year, and as your life progresses, it may change as well. But those are some of the factors I'd take into consideration. I don't know if there's anything Elisa wants to mention there at all.
I think you pretty much covered it. For most people, it's as simple as taking a look at a chart of the different tax brackets and asking yourself, what is your tax bracket now versus when you expect to withdraw this money? The idea behind an RSP is that you just save on the difference between those two.
Excellent, thank you. And we do have a question that's been posed from the group. This is in regards to a tax-free savings account. And what are the rules around having multiple TFSAs? For example, having one for longer term investments and then another for short term or emergency purposes. So I guess really just addressing what if you have multiple?
Yeah, I can take this one on. One of my clients, she has a tax-free savings account to save for her wedding and a tax-free savings account to save for her dog Benny. So as you can have multiple tax-free savings accounts, and some people like to have multiple to save for different goals. The most important thing to keep in mind is tax-free savings accounts have limits. So the government isn't going to allow you to grow $1 million with no tax whatsoever. They're going to cap you at a certain number, and that's going to be different for everyone because it depends on how many years you've been eligible to accumulate the contribution room. So let's say you can log into the CRA website to check what your unique contribution room is. And let's say that it says it's 50,000. You can have as many tax-free savings accounts as you want, quite literally, as long as you stay within a total tax-free savings account balance of that room that you have. That being said, I think it's helpful to be mindful of how many you have. It can get a little bit confusing if you have 10 different tax-free savings accounts at 10 different places. But definitely, if you have a goal for short-term savings and another one for longer-term savings, you can definitely divvy that up.
Great, thanks, Elisa. We do have a question around US stocks in a taxable account. I think we're going to take that one away. That's definitely a tax question, and we want to be sure that we get you the right answer in terms of how you report the growth, whether it be in Canadian or US dollars, and how the currency plays in. So we'll get an answer out to you on that one. If you have to cut out your savings during a downturn, are there ones that are more beneficial than others to maintain? So as an example, would you keep your RSP contributions and cut your TFSA? So again, thinking about where we're at in the world right now, and identifying that most of us have to cut something out of our budget. Do you have any thoughts on what you would recommend to somebody?
Yeah,
Flash, do you want to?
Yeah, I can chime in on that. And then Elisa, if you have anything you can add to it for sure. We kind of touched base a little on this during the presentation, but essentially this is a great timely topic and it's a common question that's coming up right now. Some of your colleagues may be going through this themselves, or you may be hearing this in your friends and families as well. It's obviously, once again, and I sound like a broken record, it all depends on your personal situation and plan and your and the situation at hand at that time. But as a general rule of thumb, you do want to remember that with RSPs, anything that you withdraw from those types of plans will be taxable in the event that you do withdraw it out. Whereas with your tax-free savings account, the withdrawal will not be taxed, obviously. So sometimes in many scenarios, the TFSA could be an easier account to access as opposed to your RSP. But it all depends, once again, from person to person. And there may be events where withdrawing out of your RSP may make sense as well. If obviously you are in between work, you're not working at the time, and you have lower income as well. So there could be points in time when withdrawing out of an RSP could make sense as well. At the same time as well, you also want to go back to, like Elisa mentioned, have that conversation with yourself again. Why did you start those accounts? So with your RSP, because generally it's meant to be for retirement, do you really want to tap into that? Is that something that you can afford to have at a lower point? Especially if you're many years away from retirement. We kind of showed the importance of compounding returns. You don't want to be obviously withdrawing out and then obviously contributing years later, because that will not just have the dollar effect today, it will also have all those years of compounding effect that you could have had over the longer term as well. And this also obviously circles back to the point on the importance of having an emergency fund and paying down high interest debt before you look into obviously longer term investing or longer term investing option as well. I'm not saying it can't be done simultaneously, but that's where a bit of financial planning and just having your goals set out may make a bit more sense. But if there's anything I missed, Elisa, I know it's a big topic. Do you want to mention anything at all?
Yeah, so if you already have these different goals that you're balancing, you're saving for your retirement, a larger purchase, trying to pay down debts, and you have a limited an amount of resources to work with, I think, again, this is where it's going to be helpful to talk to someone who really knows your situation in detail so that they can give you the detailed advice. But as a rule of thumb, I think that you should be focusing if you have something that is non-negotiable and that it's coming up and you have to meet that obligation. Maybe you're going to be having a wedding in a year and you have to pay all of your bills for that. Or maybe you have these higher debt obligations, like if your mortgage payments have gone up recently and you have to shift around your savings to cover those kinds of items. I would typically say prioritize that. Beyond that, if you have some more general savings, like a money going into your RSP, money going into a TFSA, depending on your tax bracket, I probably would say to contribute to the RSP so that at least you can continue saving for that long-term retirement goal, take advantage of the compounding interest so that you can grow your money over that time frame. And also you can start thinking, well, if you're doing RSP contributions and you get a tax refund, perhaps you can take that money and use that as your tax-free savings account. So at least you are still contributing to that account as well.
Excellent. Thanks, Elisa and Balaj. We do have a question that kind of ties into that line of thinking, and it is, if I have room in my RSP, when would I want to contribute to a TFSA instead? And again, I'll just maybe echo some of the sentiments you shared, and then I'll turn it over to you, is it comes down to the goal that you're trying to achieve and how quickly you may need to access that money. As well as the benefits of the tax break that you get when you put money into an RSP. So a few things to consider, but again, going back to your own individual goals and what you're trying to achieve.
Yeah, I think you covered it really well, Amanda. Like, you are absolutely correct. Like, it depends from person to person. And like Elisa mentioned, you want to look at your individual tax bracket and your marginal tax rate. Obviously, on deciding those factors, some common scenarios that I see obviously are where people may choose to elect to contribute to a TFSA over an RSP at certain times, or may elect to do one over the other. Is dependent a lot on their retirement income. So let's say, for example, you have a company sponsored pension plan set up. You are going to be inheriting a business or property when you think you're going to go into retirement, or you think you may be having higher income at the time because you might have retirement rental income at that time. So those are some of the common examples that do come up from obviously where people may think like an RSP contribution may not make as much sense to them, because if their income today will look very much like their income in retirement, or their income in retirement may be higher. So those are scenarios where people will look to obviously contribute to a tax-free savings as opposed to an RSP. Just as an example that I've seen in real life where people do that. But I don't know if Elisa, you wanted to chime in on anything on that topic at all?
I will chime in with one more thing. So an RSP is tax deferred. You save on taxes now, you pay taxes later. It's a double-edged sword. So if in retirement, you know that you're going to have a larger expense in one given year, maybe you know that you'll have to pay to have your roof fixed, or you have a really large trip that you want to go on. Accessing that money from your RSP can increase your taxable income in that one given year quite a lot and end up having you to pay quite a bit of taxes. So if you know that you're planning for these larger expenses in any one given year, and you know you're going to have to pull out quite a lot of savings, having that money through a TFSA can help you avoid paying a larger amount in taxes for that tax year.
Great, thank you both. So we are getting a little short on time, and we want to be mindful of those of you that have to get back to work. So I think one of the biggest takeaways for me is that your financial plan is an ever-evolving document. It's not something that you put in place today and it stays the same. So we all know that right now times are tough. Maybe you're having to cut back on savings. Maybe you're having to stop them altogether. And that's okay, because we also know that times will get better. And you can revisit your plan on an annual basis, or more often if you need to, and reinstate those savings when that becomes a possibility. And it may make a difference. You may have to save a few more dollars a month to make up for the months that you couldn't. But as long as you're checking back in on it, you will still find success. We are recording this session. We will send a link out if you want to rewatch it. Any questions that we didn't answer, we will get those answers out to you. And we are here if you have questions that come up after the fact. So the email is usable. Send your questions through Jonathan. But we are here to help in any way that we can. So thank you for taking the time to listen to us. At Vancity, we're very proud of what we do. Maybe I'll add a little bit of a comment around the socially responsible investing and the fact that that is what sets us apart. That's what makes us different. We're not avoiding a future that we don't want to have. We are now investing in a future and a world that we want to be part of. And we hope that you'll join us on that journey if that's something that you're looking for. So thank you. Thank you, Jonathan, for setting this up. Thank you to all of you for joining us, and I wish you a fantastic day.
Awesome. Thank you once again. On the Coconut side, I'll work with HR to get this recording out, and maybe there's an opportunity, tons of great information here, so I can appreciate needing to distill it and digest it. So maybe we can even do like a survey or something just to have a centralized place where we can submit feedback, and depending on what that is, I can work with Amanda and the team to maybe get some responses, or set up individual calls, or whatever makes sense. So really appreciate the time again. I found it super insightful, and it sounds like from some of the questions and responses I'm seeing, people on our side also enjoyed it. So really appreciate it. Thank you so much.
Thank
Thank
you.
you, everyone.
Thank you.
Bye-bye.